Today we have the opportunity to have as a guest the investment director of Fidelity Asia, and this is Cathrine Yeung. Welcome and thank you very much for your time and giving us the opportunity to ask a few questions about Asia. Just a few days ago, we had probably the first G20 meeting in China. And there were basically two topics that were discussed at large. And one was, the risk of this protectionism that is, actually coming out in many countries in which, economic growth has been pretty slow recently. And the other one is the issue of fiscal policy. It seems everybody agrees that we need, a more expansionary fiscal policy, but then it looks like the countries that are willing to really implement a more expansionary fiscal policy are very few. So what are your opinion after this G20 meeting?
Well, globally it's likely that we'll continue to see these expansionary measures, whether you want to call it helicopter money, just increasing fiscal deficits, regardless of who's going to win the US elections later this year. Again, chances are we are going to see further stimulus being pumped into the US economy. From an emerging markets perspective, take India for example. They need capital about $1 trillion to fund infrastructure projects over the next 5 years. And whilst the Chinese have continued their big infrastructure projects, they're trying to taper it down a bit, but they are still spending money in terms of fixed asset investment. A lot lower in terms of the pace versus a few years ago, but nonetheless still focusing on fixed asset investment, at the same time trying to shift the economy towards an economy driven by services and private consumption.
Okay, now talking about China, back in August of 2015 we had the first major, I would say, correction in equity market as a consequence of the fears of a Chinese devaluation and major Chinese slowdown. And then we had another episode at the beginning of this year in January in which markets were afraid of another big devaluation in the Chinese currency. What's going on now in China? Because at the end, it appears that they managed, to keep the economic growth at a decent level.
Yeah, well, decent is the word. The economy is going to continue to muddle its way through. So a muddling economy, so don't expect any surprises on the upside or the downside, but do expect further volatility in the markets themselves. Now the RMB concerns about devaluation have eased from a foreign sentiment perspective, and in fact when you look at the RMB, because it's weighted against a trade-weighted basket, so various currencies, it is one of the most transparent currencies that actually you can find in the world today. In terms of the equity markets, there is a focus to open up, whether it's the bond market, whether it's the equities market itself. It is a young and evolving market. So we have seen some hurdles, some mistakes, like last summer, so August 2015, the beginning of this year, with some peculiar, I suppose you could call it, regulation, which is now sort of being switched off. But we are seeing, this interest starting to pick up, especially with, I don't know if you're familiar with the Stock Connect program.
Yeah.
So the Stock Connect program, Shanghai, Shenzhen's likely to be implemented soon. And then potentially you are going to see MSCI come out with an announcement about Asia, so again Shanghai, Shenzhen names, being part of MSCI emerging.
Okay. One question now specifically on the banking sector in China. As you know, here in Europe we are obsessed with this problem of the non-performing loans, especially here in Italy. We have for sure big, I would call it, capital deficits in our banking system. What is the situation? What situation do you have in China? In the banking system?
Debt is a situation, but it's not as severe as many commentators make it out to be. Now, if we look at debt to GDP, whether it's 275, 280%, what does this actually mean? So instead, we look at the banks from a balance sheet perspective, liabilities versus assets. And when we look at NPLs, in China, there are different stages of the cycle. So the first part of the cycle has been the private sector. And bad loans, NPLs, have been recognized for the past 2 years, to the point where debt formation, the ratios sequentially come off a little bit or declined a little bit. Then you have the local government finance vehicles, and they too are starting to recognize these NPLs. They're actually looking at doing some bond issuance offshore. And then the real problem with China is the state-owned enterprises, the SOEs. Yeah. And at this point in time, there's been no clarity from Beijing or the government about when the NPL cycle with the state-owned enterprises is going to occur. Because NPLs is just one piece of the overarching puzzle with state-owned enterprises. They're inefficient. In fact, their total assets or revenue, like 100 plus state-owned companies, equates to $4.1 trillion US, which is the same size as Japan. So this is a big challenge for the government in terms of restructuring, consolidation, recognizing NPLs, making workers redundant and oversupplied segments. So it is going to take time. But in terms of the banks themselves, yes, return on equities are going to go down, NIMs are going to go down. We don't think we're going to have a Lehman type of crisis in China.
Okay, one question about the Central Bank of Japan. We just had the meeting, and actually it was a little bit of a surprise. We actually feared that they would push interest rates even more negative, and instead now they came up with this idea of a controlled yield curve shape. So what is your opinion about this decision?
Well, the market reacted quite favorably towards the decision. And when you look at what the Bank of Japan has in terms of their tool set, very different to, let's say, the PBOC in China. So it's almost like they could be at the end of the road, so to speak, in terms of they're going to have to now definitely focus on the fiscal side. And if you recall Abe-san's three-arrow approach, the structural reforms arrow, this is where their attention needs to be focused. Whether it's reforms on immigration, infrastructure reforms, it's likely this is where the news flow will come out. But Abe-san, he has very favorable or high popularity at the moment.
And now my final question to portfolio manager is very simple. How do you invest your saving now?
When we look at the situation in Asia, and I know there's still a lot of criticism about transparency, be it at a government level or a corporate level in China, but being on the ground and doing our research, really identifying and distinguishing the DNA of a company, that's really key. And in terms of broad-based themes, you can't go past the rise of the Asian consumer. Whether it's mass market consumption in China, the rural consumer in India is 850 million people. The spend of Chinese travelers, you see them in Milan coming through and just what they're purchasing. Their spending power is huge. But I also wouldn't ignore the old China names, which very much are still not liked by investors, generally speaking. Some of these state-owned enterprises or big companies have really cleaned up their balance sheets, have got good management in place in terms of aligning themselves with minority shareholders. And very interestingly, people don't associate Asia ex-Japan, ex-Australia with yield, but we are seeing some of these companies pay a 5 to 7% dividend yield. Payout ratios across Asia are only 30%, so could go higher. And when foreign investors once again look at China, let's say A shares are included in MSCI, it will be these large cap names, the total return names, that they will likely flock towards.
Okay, Cathrine, well, thank you very much. It was really very interesting. And actually for us, even more interesting because we have had this positive view on emerging markets, both equity and debt in this past year. And for sure, Asia is a very interesting area where to invest for us. Thank you very much.
Thanks, Manuela.